Today I'm going to be walking you through how I went from $7,000 to scaling up with the goal of building a seven-figure capital management system. I'm also going to go over how I experienced a $160,000 gain within a month. This isn't about luck or a single perfect trade. This is about systems, this is about discipline, and a long-term approach to capital management systems. So let's rewind and break all of this down step by step.
5 years ago, I started my self-directed investing journey with about $400 a week in cash flow before expenses. I didn't have much direction, but I knew one thing. I needed to experiment while liquidity conditions were favorable. In those early days, I was chasing returns wherever I could find it, and it worked until it didn't. When favorable liquidity environments dried up, my $7,000 account had doubled to $14,000 while liquidity expanded, but as it contracted, I watched it bleed all the way down to $3,000. I tried to catch falling knives in my first real bear market, and I paid the price. Even through those losses, I remembered the small wins. The first time I made $1,000 in a day, the first time I doubled my account over a year. Those wins kept me grounded because if I could do it once, I could do it again, but better. Looking back, those wins weren't random. They were tied to one thing. That one thing is systems. Even in my early success, I was unintentionally following a structured dollar cost averaging strategy. All I needed to do was refine and scale that system intentionally. I started allocating a set amount of capital every 2 weeks. I held cash reserves for more severe dips. I focused only on assets where I did deep research into fundamentals, leadership teams, project history, financial strength, stocks, crypto, real estate. Each asset had its own system calibrated for its own unique risk profile. At a certain point, you have to think beyond just strategy. You have to think in terms of edge. But there's a catch here. Edge without a system is liability. It's just ego disguised as skill. So the second you think you have an edge, but you don't have a disciplined system to support it, you're gambling. Maybe not in a way that feels reckless, but structurally, it's the same as a casino model with a negative expected value or a negative embedded edge. I think the free markets are special because unlike most fields that you could step into with a low barrier to entry, they allow the average self-directed investor to create their own positive embedded edge. But to do that, you need a system. Risk-adjusted returns, Sharpe ratios, Sortino ratios, trading rule sets, dynamic risk parity, delta-neutral hedging and skewing. These aren't just academic terms. They're essential tools to make sure you aren't bleeding capital without realizing it. So every capital management system has one job: maximize upside potential and minimize downside risk. The big mistake I made early on was thinking risk was something you just accept. Later, I realized you don't accept risk, you engineer around risk. The better your risk management, the more upside you can afford to seek. So risk management isn't just protecting your downside, it's actually what lets you scale your upside safely over time. The big realization for me was that systems grow growth itself. At low levels of capital, you can only afford to run one system. As your capital grows, you can multiply systems, create diversification across assets, and optimize across market cycles. Your Sharpe ratio grows, your compounding grows. You don't just have more money, you have more ways to grow money faster and safer. This was the key behind my $160,000 month. I wasn't just swinging for the fences with reckless leverage or other rush-inducing financial instruments. I had systems running across spot, crypto, stocks, real estate, all harmonized. The majority of the total systems I had were rotating and compounding into each other. So in December, favorable liquidity, deep value positions, and patient system-based holds all aligned perfectly. My cost basis across everything was around $45,000 for my main portfolio, and by month's end, I was sitting at $230,000 in just my main portfolio, which is around a 500% unrealized return, with $160,000 of that occurring in just 25 days. And I could also figure in stocks and properties values into this $230,000 waterline or all-time high in my portfolio performance, but I'd rather not sandbag my performance just to further prove my point. You got to have systems before growth. Most investors think growth is about picking the next big winner. It's not. It's about building a system that can survive in bad conditions and thrive in good ones. When you're starting out with $7,000, it's not about getting rich off of one asset. It's about following a system until you prove that system works. Once you prove it, you personalize it. You tailor it to your life, your strengths, your risk tolerance. You add new systems slowly as your proof of concept succeeds. In the end, capital management is just condensed discipline. Whether you're doing it manually or running algorithms at a quant fund, it's the same principle. Systems compound and impulse drains. My $7,000 to seven figures journey isn't about one moment. It's about consistently building self-reinforcing structure that has scaled itself over time, and that's what you should focus on too. So to expand on this, you should first start by analyzing for liquidity events approaching or receding to get a general idea of how you'll dollar cost average. I would DCA normally if you can capture deep value, especially with blue chip assets or projects. Rotate profits when it's smart to in order to rebalance and position yourself for more upside exposure with less downside risk. This is a system in itself, just to remind you. What comes after this is focusing on growing growth. You go from a standalone system like a bi-weekly DCA method to multiple systems over time. For example, you might move forward with your own due diligence on dynamic risk parity systems as your DCA system heavily yields returns in the long term. Due diligence on risk-adjusted methods would likely lead you to finding that high Sharpe ratios means great returns and also potentially great losses maybe. If you hold assets with high Sharpe ratios, you should at some point in the near term use dynamic risk parity systems to sell with the intention of rebalancing into assets with lower Sharpe ratios. This is just an example, but it's true. With more capital, you can adopt more systems. So this point I'm about to make might sound random, but in a moment, it will tie into one of the main points in this video, which is the overarching question of what is the best system. So if you run the arithmetic for a standalone system, it's almost a prerequisite that you can't have multiple systems or asset classes with a respective system for each asset class if you only have a 4-figure account. Like some shares for certain companies are hundreds of dollars and some derivatives contracts are thousands of dollars per contract. So what is the best system for growing growth itself? It's probably not something you couldn't guess at this point. The best system for growing growth itself is diversification across assets and instruments, but with key considerations. So if we look at page 170 of Robert Carver's book, Leverage Trading, you can see that the more asset variety you have, the higher the Sharpe ratio, which is vital for optimized returns. And yes, Sharpe ratios alone aren't magic. Execution matters, but they're a proven compass. Target high Sharpe ratio assets and overall holdings. This is a growth engine. Diversify dynamically. This is Carver's most raw edge. Paramount and Sharpe ratio lift occurs from this. Scale via risk parity, so you protect gains and you compound harder. With a larger account size accrued from DCA growth, you then have access to accrue more systems, and this will really improve returns, maybe even exponentially. The simplest way for me to elaborate on this is to make a real-world example. Let's just say I have $200,000 total account value. I can run formulas to decide systematically how much of this $200,000 will be allocated towards leverage trading, stocks, crypto holdings, selling options against 100 share lot, buying straddles and strangles with profitability on both ends of underlying price action, monthly yielding dividend stocks. Pick any asset, you can run a formula on it, and now you'll get a clearer picture as to what your fund looks like as you gauge all of these weights. The proof of concept here is that with a standalone DCA system, you can make $160,000 in 1 month performance without going hard into math by just stacking by dollar cost average as I have in this past December. If we follow a more advanced protocol in succession to this performance, we're led to a formulaic process that not only indicates we can afford more capital instruments, but that we need to adopt more capital instruments or asset classes to increase profitability and reduce downside. We could also just use deduction or figure out that this is the most obvious next step, but this doesn't allow you to accurately calculate our optimal exposure for each portion of our asset allocation. When we follow a rules-based system for branching out our capital allocations based on all or at least most of the most important variables present in our portfolio, we get surgically precise structure in our asset or financial instrument allocation that optimizes for upside potential and diminishes risk to the downside. The computations used to make decisions for the initial structure of the portfolio going forward can and should be used to rebalance the portfolio when you hit optimization milestones in all of the branching systems. But anyways, if you have the weight or the balance of your portfolio optimized systematically across the board, the next obvious step is to dive into adding structured systems for each financial instrument or asset class, and each system will have its own nuanced optimization parameters. Buying and holding stocks or crypto will have a different system compared to selling option contracts for premium or buying option contracts to sell once they return a yield. You'll adopt a different method for each, but for example, being a long-term holder requires a methodology based on grit or systems that optimize for survival while overall conditions improve. Profiting off of options, for example, requires systems with a methodology predicated on more cerebral problem solving. So over time, you've slowly built your 4 or 5 figure account to 6 figures. What do you do from here, right? So you start to weight things, you start to rebalance things. And as for what asset is weighted as what in your portfolio, you can just evenly split all of the weights and trim to even out heavy gainers as you go. You can also remove assets if the management of them isn't profitable. And if you do this in a penultimate fashion. So basically the most recent asset and respective system you've added that has failed or has become unsustainable gets removed. It's a last in, last out, penultimate slashes sort of style. Pros like Robert Carver, and for some reason a lot of quants do this baseline even splitting of total account value across all assets in their portfolio. But I think it's way too inefficient. It's simple, but it's blind. It's agnostic to the actual quality of each return stream. So I opt to use the risk-adjusted discipline to find my asset weights between all assets and financial instruments to better gain return stream efficiency. To determine optimal weighting of each asset class in your portfolio, I'm using a risk-adjusted framework that prioritizes Sharpe ratio, so risk-adjusted returns, correlation penalization to avoid overexposure to similar assets, volatility scaling to reduce exposure if one asset becomes too risky. And as for how this gets broken down step by step, we start with the Sharpe ratio equals the expected return minus the risk-free rate divided by the volatility. We can assume that risk-free rate equals 0% for simplicity. Baseline weight calculations are equivalent to the Sharpe ratio of an asset divided by the sum of all Sharpe ratios. So for example, if an asset has a Sharpe ratio of 1.43 and the total Sharpe ratio sum is 6.56, the weight would be equivalent to 21.8%. The correlation adjustment is simple. You can run this formula, and the closer it is to 1, the more you should basically adjust your exposure to that asset to balance things out better. The isolated return is equivalent to the allocation times the expected return, and the total return equals the sum of all isolated returns. So you should fit your system or holdings around your life with overarching principles. For example, I don't want a highly weighted position in crypto perps, even though the Sharpe ratio and Sortino ratio is high, and the Sharpe ratio arithmetic indicates I should have a 34% position in perps. And the correlation is also 0.8, which is another indication that I should diversify better anyway. But so like I was saying before with dynamic risk parity, I can use the overarching principles for dynamic risk parity to reason that I want to reduce my exposure to crypto perps and therefore pile more capital into branches in my overall system with positions that still have a lot of room to the upside. In this example, I'm opting to do this because I know that generally Sharpe ratios are elevated or higher when an asset can have more limited room to the upside in some cases. So rather than get myself locked into a position where I have limited upside potential near term, I can weight more of my capital towards assets with lower Sharpe ratios that show eminent increases in pending Sharpe ratio or price action looking further out based on historical trends with Sharpe ratio overlay on a price chart of any given asset. So I just plugged in all the variables and the numbers into this spreadsheet, and you can see that it gives you very solid returns if you're using this risk-adjusted framework. And you could even go further. You can combine Sharpe ratios and Sortino ratios, basically do a cost-benefit analysis as to what ratio is better for what asset. That's what I've done here. And as you can see, it's improved just standard Sharpe ratio arithmetic compared to mixing in a little bit of the Sortino ratio math. We've dramatically increased our annual return. And then, like I was saying, you have your independent systems for each asset and financial instrument. Just to provide some examples, I have a detailed process for perp trading and option contract exposure, and these standalone systems will never be complete. They'll always be built upon and improved just like your overall portfolio, and I'm just bringing this up while all of this is relevant to make it clear that this isn't just about returns as much as it is about finding the balance between the seriousness of putting real money on the line and the play and the fun that comes with being numb to numbers and dollar amounts, so that you can properly embrace that finance is a game where the best players can win. You can see how going from $7,000 to 7 figures in a streamlined way is not only possible with Structured Edge, but practical. And I mean practical as in you aren't going to burn an account by following rules-based risk-adjusted systems unless you break a streak in discipline. It's also only going to get better, Personally, I'm only making revisions to my holdings once a year because I don't want anything to do with major short-term capital gains. So I have a year or more in between when I sell and buy into different positions. And that's a whole year of due diligence and getting better and gaining more experience, which will only make the next revision of my overall personal fund perform better. So who knows if a 7-figure milestone takes several years. It might only take 3 years or less. All of this is just scratching the surface in terms of capital management systems. There's a lot of hypotheticals beyond a 1-year projection or even a 6-month projection. Like, what if the market goes down or sideways? There's a lot of what ifs, and all of the what ifs are welcomed because they imply price direction. I'm perfectly happy with having directional exposure as well as hedging to get my delta more towards neutral. If you have a big, obvious what-if event materializing on the horizon, at least for this portfolio in this example, you have strategies and systems with options that can profit off sideways price action as well as sideways Greek dynamic action, like iron condors. And you could also sell against lots of 100 shares that are being held in a more aggressive way to collect more premium. And of course, you have short selling systems that allow you to safely profit from downside action. If I were to dive into all of these tangents, it would have to be a different video or a handful of different videos, really. But I think I've gone across all of the points I can make within a reasonable time frame. So hopefully you have leads towards new ideas or due diligence for growing your returns. You can make all of this as simple or advanced as you'd like, and delving into the more advanced capital management system dynamics for the purpose of creating systems with more elevated levels of positive embedded edge is going to be an energy drain on your mental reserves. But the way I like to think about this personally to get all of this done in a more or less painless way is for me to remind myself that for the price of thinking as hard as I can, I get to form an arguably low barrier to entry path towards making great returns on investments like what I did to reach $160,000 in a month. And all you need to do is to make all sorts of big wins, little wins happen once, because if you can do it once, you can do it again, but better.